Welcome back, ladies and gentlemen, to the All In Crypto Show. Today, I am delighted to be joined by Ben from the MoreCryptoOnline YouTube channel to talk to us about his views on the market from a technical perspective. We'll maybe touch on sort of things a little bit fundamentally, but this is going to be a very technical focused video interview. And I'm very, very excited to welcome Ben on the show to talk to us about the things that we've just discussed. So welcome on board, Ben. It's a real pleasure to have you here.
Yeah, thanks for having me. Well, thank you. Yeah, very, very, very happy to be here. Excited about what's coming today.
I'm very excited as well. We spoke a little bit off camera the other day, and it just got me really fired up for this. You know, some of the things we were speaking about, I just couldn't wait to get recorded and get on my channel. So very excited to be doing this. I always like to start with my guests with a little bit about themselves and perhaps how they found themselves where they are today.
Yeah, so I mean, I've always been, not always, but so from the age of 18, I think that's when I really became interested in financial markets. I mean, I'm not 35. Not many might know that. I don't know. I don't talk about that very much. Maybe in our group. But yeah, I've been focusing on these markets, generally financial markets, for many years, more than 10 years certainly. And with 18, I really started when I was studying sort of on the side. Was interested in trading, but probably started at the worst time because it was in 2008 when when the stock market basically crashed, and I bought some bank stocks and blew up my portfolio. That's where I really started. But it was not, I mean, at the time it was a lot of money, but looking back, it wasn't that much. But obviously that's where a lot of people then stop dealing with financial markets and they get frustrated. They will never look at these markets again, never look at stocks and shares again. But yeah, I was still interested, so I learned a lot about risk management and everything, and then step by step got more into trading. Tried a lot of things. Eventually stopped at Elliot Wave, because I looked for risk management tools, and Elliot Wave I think is a great one. So I've always been doing this on the side, really, sort of trading and analyzing different markets. At some point then crypto started to get really interesting. And yeah, last 2 or 3 years, since then I've been doing this full time.
Yeah, fascinating. I love the fact that you started in 2008 with your initial kind of involvement in the traditional financial space. I think all of the best technical analyzers, marketeers start under similar circumstances. And actually what separates a winner in the financial markets from a loser, I would say, is the perseverance. A lot of people, we could maybe liken it to 2017. On the crash of 2018, they got out of the market. Whereas actually, if you had stuck around and you would sought a deeper level of understanding of what's going on here, it could have been the making of you. And I absolutely love that story. You also mentioned risk management. I know on our conversation off camera, you actually had mentioned that you think Elliot Wave theory is a very good way of risk managing. And that's one reason why it appealed to you so much, which I'm sure we're going to kind of get into. So I'd like to maybe just touch a little bit on your views on Elliot Wave theory. So you'd call yourself an Elliotician. Why Elliot Wave theory? What was it that stuck out to you with that?
So what I really like about Elliot Wave is it's universally applicable to all markets. You can really, I mean, any market that's publicly traded, you can analyze it. So it gives me a really good overview, even just from a very high level, if a chart is good or not. So I could not analyze so many crypto charts and stocks and shares and everything on a daily basis if I had to develop a unique approach for every chart. So with any other TA method, I would need to look at indicators. I would need to look at so many different levels, and it would be a very bespoke approach for each chart. Whereas Elliot Wave gives you a universal view, and if you can read the waves and if you can understand how to use it, then it saves you a lot of time, and you can really just screen a lot of charts very easily. So that's one great advantage of Elliot Wave. Universally applicable, and it's very quick to assess the quality of a chart and where you are in a cycle. Then obviously it gives you great reward to risk entry points and also great exits if you understand how to trade it. And it's a great risk management tool, which is perfect for crypto anyway, because in crypto, a lot of people are really suffering from the volatility. They think the volatility is good, which actually it is. You can make money of it, but a lot of people, just take too much risk in an already very volatile market, and Elliott wave really helps you to manage that risk, because you know when your view gets invalidated, so you have to adjust, you know when to adjust. Now, if you do it as a trader, that's something different. You know, that's where the emotions come in. But from an objective point of view, you know when your perspective actually should change. And a lot of people still don't change their perspective, which is fine. But that's then where the analysis differs from the actual trading skill. And then what I really like about Elliott wave is obviously it gives you, I think that's quite unique. And I haven't seen any other method that gives you that feeling or idea of where you are in a cycle, that roadmap. Now, I always say that roadmap, also what you see here on the Bitcoin chart, it's not a crystal ball, it's more like a guide path, and that you know when things are starting to get wrong, then you know when you have to adjust. But it gives you a guide path, and you with no other method you have that context. I think, you know, some people use like head and shoulders patterns, and sometimes I bring them in as well, but I would never use them without Elliott wave. So I always say, you know, why should I use them? Because with Elliott wave, I have the context that, for example, a pattern like head and shoulders, or I don't know, double bottom or things like that, they just don't give me that context which Elliott wave gives me.
Yeah, I love that. You touched on quite a few things. And I think one of the unique things really about Elliott wave theory is its ability to give you that roadmap, which is invaluable in a kind of situation like the one where we're in at the moment. You know, there's a lot of kind of macro uncertainty. There's a lot of factors at play when it comes to the markets. And this comes back to why it was I was so excited to have you on the show, another technical analyzer, because it's absolutely my belief, and I'm sure it's yours, that technical analysis is an extremely valuable tool. It's not voodoo. Yes, there's an element of predictability with it. And of course, it's a possibility-based game. But especially for times like right now, if you have technical analysis to fall back onto when there's a lot of sort of uncertainty in the kind of economic environment, it can really help you get ahead of your competitors. And Elliott wave's kind of, I wouldn't call it you could maybe call it a predictive nature, but roadmap kind of nature. It's very unique in the sense that it kind of forecasts where you may or may not get to. And I'm sure, do you sort of incorporate Fibonacci levels to help you work out where these Elliott waves may go to, or what does that process kind of look like in regards to a roadmap?
Yeah, so I mean, I always start, obviously, we look for impulses. So an impulse, for anybody who's not familiar with Elliott wave, we say that markets move in 5-wave structures. So it's basically this, if you can see the screen. So that's an impulse. There are certain rules. It's much more complex than that, but there are certain rules that you need to follow to detect an impulse. So yeah, you use Fibonacci extension levels, Fibonacci retracement levels, and you want to see that 5-wave move on a chart. If you don't have 5 waves, it could be anything. It could be just a corrective chart that breaks down again. So you want to see those impulses on different time frames. There are different structures in Elliott wave and different ways how they can move, but an impulse is that what you as a trader, what you're looking for. So you basically look for these 5 waves, which will then look a little bit like that. So you've got your 1, 2, 3, 4, 5. The best setup that you get as an Elliott wave trader is when you have 5 waves, which are reliable. Not all 5-wave structures are reliable. So that takes a lot of experience. And you use the Fibonacci levels to find out what's actually reliable and what's not. And then after 5 waves, you're looking for the pullback, because you say, or we know that a market that moves up in 5 waves is in an uptrend. So I normally say, and that's typically what it is, that the lowest risk trades that you can take, call it trading or investing, you know, even as an investor, you want to get good entry points normally. So you're waiting for the market to tell you that it's in an uptrend, and then you wait for an ideally quite deep pullback. And the pullbacks in the crypto market, they are often quite deep. So that's very challenging from an emotional point of view. And these pullbacks, they typically happen in 3 waves. So that's the most simple structure how a trend can work out, you know, 5, 3. That's all related to Fibonacci itself, because, you know, 5 and 3, they are Fibonacci numbers. Funny enough, you know, everything in nature is sort of structured that way. It's those, you know, those relationships. Even in your body, you've got 5 fingers, you know, your arm, you know, is made of 3 parts, the hand, the lower arm, the upper arm. And so that's sort of, you know, everywhere. And those relationships. So Elliott wave tells us that basically also human emotion works that way. So if you have 5 up, 3 down, then ideally you look for an entry point quite close to that. And to determine that entry point, yeah, you use a lot of Fibonacci ratios, and every wave has different rules. And obviously, again, it's not an there are rules, there are hard rules, but a lot of it is interpretation. But the thing is, if you have an impulse, then most Elliott wave analysts will tell you the same thing. Whereas if you are moving in something different than an impulse, you have probably 10 different interpretations from 10 different analysts. So ideally, as a trader, you wanna trade what's clear, which is you look for the charts that give you that clear structure, 5 waves up, 3 waves down, and then look for an entry point here, because this is where the reward and risk ratio is best. Because after 3 waves down, you typically get another 5-wave move to the upside, and that's typically a very aggressive move then. And that's what could be coming for Bitcoin, for example, right? So you look for that entry point here somewhere, and again, it depends on the time frame. If you are trading for the next bull run, or looking for great entry points for the next bull run, you don't need to be bothered about the perfect entry point on the hourly time frame, for example, but you find these structures on all time frames, basically.
Yeah, and with the correction, so the first impulse, and then you're going to get an ABC correction. Where would you not want in regards to Fibonacci? I love what you said about Fibonacci, because I've actually done quite a bit of studying on Fibonacci, and it does come from the sort of laws of nature, if you will, and more of a universal kind of law that we've applied as we do to the charts. But in regards to that correction from the impulsive move, where would you not want to see fall in regards to the Fibonacci? You're looking at the 50?
We look for it. Again, it depends on the wave. So on the Bitcoin chart, and on the Bitcoin chart, we're probably dealing with a wave 2 at the moment.
Yeah.
So again, that could be 2 of these, 5 waves up, 3 waves down, or it could just be one large. That's maybe too much detail now. But the thing is, you are watching in a wave 2. A wave 2 can be quite deep, and that takes us to the different. I mean, the waves are nothing else than, they basically tell us in a mathematical way how the emotions, they basically reflect the emotions of the investors and traders in the market in a mathematical way. So we know that in a wave 2, this is basically the area. So normally it starts at the 38.2 retracement level, but I normally want a wave 2 to go at least to the 50%. So between the 50% and the 78.6. So we talked about the ABC structure. Often, it's not always the case, but often the A wave reaches the 38.2. Then we get a corrective rally, which might be happening right now. And then you get that last wave down. And ideally, we don't want that below the 78.6 retracement. It's, from experience, it's not a hard rule. If you look at Elliott wave books, they will tell you that obviously in a wave 2, which is the, after the first impulse, basically the first correction, which is normally quite deep. And it makes sense it's deep because it's sort of the, if you have the first 5-wave move to the upside after a long downtrend, basically a lot of traders, investors, or market participants are still very insecure. So you see that in the sentiment, there's a lot of uncertainty in the market. So people don't really know if the uptrend has started. That's why you see everywhere on crypto Twitter, everybody's got an opinion. Okay, has the bull run started or not? So, but that's exactly what we see in the waves, because we know that in a wave 1, which the move to the upside was, again, we can debate if it finished here or here, but that tells us that, okay, possibly an uptrend has started. A lot of the investors are still very insecure. So it makes sense from a psychological point of view that a lot of people will start selling into that rally, and the pullback is therefore quite deep. And in a wave 2, we expect a deep retracement. And that's because a lot of people expect in a wave 2, the bear market is back. Okay, so that's typically when it happens on a large degree, so on a large time frame, basically, you also see a lot of negative news. So it's quite funny because it's the mood that's reflecting that. So it's quite funny. Sometimes the chart actually tells us that negative news should be coming up, and you expect those news somewhere low in a wave 2. Like, example in March was a lot of these banks in the US were going bankrupt or collapsing. That was great, a great example. Another one here that was a very deep correction. Now that's a wave 4, but it's similar. It's also a correction that was in November. That was FTX. Yeah, the low was FTX. So it's typically when there's a lot of fear. That's also when I start to buy. But I'm not blindly buying the dip. I use the structures and the fib levels to tell me when I should buy, if it makes sense, because you don't want to catch the falling knife. So if I know that possibly an uptrend has started, then I will start to scale into this pullback. But if it goes below the 78.6 retracement, I have to prepare for, it basically means that the sentiment is probably shifting, and that I have to then assume that the market failed to create an impulse. So obviously it's no crystal ball, as I said, but at the moment we have impulses to the upside. We have something that looks like a correction to the downside. A lot of insecurity in the market or uncertainty in the market. A lot of people think, we get new bear market lows, and that's typical for a wave two. And if there's just a little bit more fear when we come down here, then the wave two has done its job, basically.
Wow. Yeah, absolutely fantastic. And I love the fact that you've tied in the kind of emotional reasons. Markets are just a representation of what people are doing with their money, basically. And human beings, emotional creatures. We're all emotional. I think it's one of the biggest cliches in trading, although a very true saying is that you shouldn't be emotional. We're all inherently emotional. I think the key to managing your emotions is learning how to deal with them and putting things in place, whether that be habits or things to kind of get around the impulsive reactions that we get. But I love the fact that you have actually, and this is, I think to your credit, a true sign of somebody who understands this theory. I love it how you've attached the kind of emotional psychology of what's actually going on with a wave two. And you can see that being very applicable today with where Bitcoin is. But I want to take you back and I want to kind of zoom out and maybe look at a bigger time frame, maybe a weekly time frame for Bitcoin. Yeah. And for you to just maybe give us your take technically on where you think it's heading. What does the roadmap, what does the Elliot wave roadmap look like for Bitcoin?
So yeah, I mean, this is the all-time chart. I always say I'm not sure how reliable the first wave up is into the 2011 high, but you can call that a wave one. So the very first impulse, very first correction, right? And then you have within that third wave, so circle wave three, yeah, you have a lot of subwaves. So you have to work them out. It's not as simple as you just put the numbers there. You have to work out what's the best count by using Fibonacci levels. There will be other interpretations, but that's what I get to with using the Fibonacci levels properly. So it tells us basically that Bitcoin hasn't even reached the top of its main third wave. So this will take years to play out, maybe decades. So it's in a very stable uptrend, and as long as certain levels aren't broken to the downside, it's in a good place. What it also tells us, though, and I always tell people ignore the timeline, because you can't say how long something takes, and also ignore. I'm not saying this will go to I don't know how many $1 million, right? Obviously, I have to place them somewhere where it's visible. I always try to work to the next target. So my target for the next bull run, that would be here on the weekly chart. Basically, it assumes we bottomed in a wave four. Obviously, it's a wave four of an even larger third wave and so on. So that's how these you get waves within waves, and that's how these build, because each we talked about the main 5-wave move. Now, if you just look at the 5-wave structure here, circle 5 waves, yeah, that's the main structure. So when they are completed at some point, maybe I won't even see that 5th wave right in my lifetime, I don't know. But then we get a major crash or major correction, because then we have an even larger wave 1 complete, and then we come down in a wave 2. But that will take decades, I don't know how long. So but just as an explanation, you get these waves within waves. So within that circle wave 3, you also have 5 waves. And then you see here, next bull run top should be the top of this third wave, or not even that. It's actually the even smaller degree. So the target actually should take us to around about 115 to 175K. That's sort of the ideal target in this move up, which might have started already in November last year. It can always go a bit higher. We can calculate that more precisely when we get closer. Yeah, that's sort of, and that is still the target, even if we make another bear market low. It would just be delayed a little bit, but that should be where we are heading. And then obviously after that, we get another correction, another rally, and so on. But it should constantly make higher highs, higher lows. But what the analysis also tells us is that maybe, and that's an explanation of why Bitcoin is getting less and less volatile, because from an Elliott wave point of view, the main, the third wave rallies here, we typically say a third wave, yeah. So you have your first 1, 2, and then the third wave is the most aggressive wave. So we're obviously in the third wave, so it's still decent rallies and everything, decent volatility, decent rallies to the upside. But the thing is, the third wave in the last, so this was the rally into 2017. We call that the third wave of the third wave. So that was very aggressive, because the third wave in the third wave is even more aggressive. So they are like the FOMO waves. But what it tells us basically is that we're now getting towards the end. So we're in the fifth wave now of a third wave. So the fifth wave is typically, it can be very choppy, very slow, very difficult. That's what we see at the moment in the market. Yeah, it's very, you see a lot of up and down. You know, you see it's been horrible this year. I mean, Bitcoin has been moving sideways most of the time. That's exactly the reason for it, because we are in this kind of sentiment, in this fifth wave where, yes, we're still in a higher level, strong uptrend, but on the lower degrees, you get the exhaustion already, okay? So that still means we can get to all-time highs. It might just not be a straightforward rally as we had it in 2021 or in 2017, for example. And then afterwards, another 4 and another 5. So I think while the next few years will be very profitable, it probably won't be such a crazy rally as we had it before. And funny enough, you can very much tie that to the whole money flow everywhere in the world. You know, it's sort of quite funny to see that obviously restrictive monetary policy, and people have also less money available, and that's exactly when the sentiment shifts as well. It's quite interesting. So again, the fifth wave is normally the last wave of a cycle, so you get this exhaustion and everything, and things are not as easy anymore as they were in the third wave maybe.
Yeah, I think you are probably one of the first people to give me a technical reason with why things aren't perhaps as straightforward as they once were, or as explosive as they once were. And actually, that's a technical reason that I think has very much been validated by the year that we've had, the kind of macro situation, which is a very interesting one. And this is why technical analysis for me is absolutely king. I always get the comments saying, you know, technical analysis is like astrology.
No.
Not really.
I think, yeah, exactly.
And when I probe a little bit deeper with the people that are putting that comment forward, I always tend to find that they've really never actually delved in and tried to understand it. And I think, you know, unless you try something properly and truly, it doesn't just mean that you've put a leverage trade on the crypto space and lost your money. You know, it's you can't really, I don't think, properly speak on it. And I'm 100% convinced on technical analysis. I believe genuinely it's the footprints in the sand. It will make you an insider almost, because you're seeing what is happening with the markets. And I always go back to this. Before the sort of 9/11 happened, you actually had certain individuals predict that there was going to be a market crash, obviously not knowing what was going to happen based on the way that they were seeing the charts looking. And I think that's very powerful. Very interesting. I love that kind of emotional or technical explanation to why crypto's acting in the way that it is. And the vertical lines that you have on your chart, are they the halvening?
Yeah, roughly. So I think that's actually now in May. I think the next year's halving. That's roughly where the halving is. Not the exact date, I think, but it's roughly where the halvings were. I don't really use the halving cycles. I always say, yes, they're interesting, but people say, you know, after the halving, it's always gone up, and before the halving, but Bitcoin has always gone up. So, you know, it's we just don't have enough data. I think you have, you know, only so many halvings, and you can't use that number of halvings for a trading strategy. So it's just something people talk about, gives you nice views, you know, when you put them into, you know, people like talking about this stuff, but it's not really useful for a trading strategy, in my opinion. I don't need to use it because I've got Elliot wave, you know, and the halving doesn't give you entry points, it doesn't give you exit points, and it doesn't really tell you much. So I rather use the cycles that have proven themselves from Elliot wave. I still have the halvings on here, sort of just to show them, and, you know, just because I'm tracking them still, you know.
Of course.
But I wouldn't I wouldn't put too much emphasis on it. But, you know, the reason why technical analysis is, in my opinion, the absolute key in crypto. I mean, how many people have bought cryptos and coins just because of promises and everything? Because fundamentals aren't really useful, especially not in crypto. I mean, that's my view. I think crypto is the market that moves in terms of, you know, moves mainly because of sentiment, and you know that it's, you know, they're mainly moving because of hype. So a fundamental reason has only really a meaning, or something that's so-called tokenomics or whatever. They really only have a meaning if people act on it, and that all comes back to sentiment. So, you know, I always say no tokenomics or anything has protected any coin from the bear market. And so fundamentals, I only use fundamentals when it really comes to, okay, do I want to invest in something or not for the long term? But my take is because a lot of altcoins are just experiments, and there aren't really any fundamentals in crypto. I always argue that. Now, that's different to what most people say, but they are very much experiments, and the only fundamentals really that I think matter for investing are actually like cash flow, what you get, stocks and shares, earnings, things like that. But in crypto, you don't have that. You have a very untested concept of tokenomics. Utility isn't really a reason why a price should go up. It all comes down to demand and supply and demand, and without demand, prices won't go up, and you only get demand with hype and when the right sentiment kicks in. And the Elliott waves tell us when that is, and that is typically the third wave. That's what you want to trade. That's the FOMO wave, when the FOMO kicks in, and that is the wave that if Bitcoin completes the current correction, we should get into a third wave rally, and that is the FOMO wave, where a lot of people who haven't used the bear market to build a portfolio, they will be left out, and then they have to buy higher, and that will drive the prices up. And that's why we get these aggressive third wave rallies typically.
Yeah, brilliant. And I love your sentiment on fundamentals, and actually relating it to the crypto space. Crypto really is just completely speculative. I mean, there's no way of getting around that. I really don't think there is. It is basically a speculative asset. We are going to move into a world where utility becomes more and more of a thing. There are certain tokenomics that will dictate demand being up, but that's once you see real world utility, and we can track that sort of stuff. And we're nowhere near there yet, to be honest. Again, which is why technicals are such a thing. And if you are listening to this, and I'm not sure why you're listening to this, because this is a really technical dive into things by two people that champion technical analysis. If you are just fixed on being fundamentally in a project, what's the harm in also trying to learn technicals? Because for me, I absolutely love it when I look fundamentally into a project and then I look at it technically. It doesn't have to be a crypto, it could be a stock, and I go, wow, both roads lead to Jerusalem,
exactly. And I would, for example, not trade a coin where I think it's fundamentally is great, right? But where the chart is absolute rubbish. Whereas I don't have a problem with, let's say, trading Dogecoin. If the Dogecoin chart shows a good setup, I would still trade it, even though fundamentally, I mean, what's there, right? I mean, okay, there's the Doge army and but it could be that even the stock. I mean, if I think a company might head to bankruptcy, but the chart shows a good setup, I might still trade it. So that's the difference between technicals and the fundamentals, really.
Yeah, and I think technicals win, and I think we've both probably seen enough of that to be convinced on it. I love that. I love the fact that you kind of said, look, even if something's fundamentally great, and I get this all the time whenever I'm going out for dinners or I'm talking to people and they kind of know what it is I do. I always get people talking about how great this is or that is and what they've just invested in. I always say, have you looked at a chart? And the answer 9 times out of 10 is, well, why would I need to look at a chart? And I'm thinking, I mean, you're vulnerable, I think, at that point. Yeah, very interesting. Now we've taken a kind of a macro view, if you will, on Bitcoin, a kind of overview on Bitcoin. Could we maybe move into where you think Bitcoin is today on more of maybe a daily time frame?
Yeah, so that's the daily time frame I'm tracking. You can also interpret that in different ways, but my view is we have either. So I said, you can have 5 waves up, 3 waves down. That's what we're looking for. So we had, of the November lows, 5 waves up. I mean, that's pretty clear, 5 waves. It's pretty clear. So we've got 5 waves up. I don't necessarily like the look of this move down. But I still see it as 5 up, 3 down. So a so-called, we call that a 1-2 setup, because that means this was the first wave up. This was the, first wave 2, very deep. There was a lot of fear here. Now, you often see a wave 2 is very sharp, oftentimes. It's very sharp, can be, if it's an impulse. So if, again, it's a 3-wave move, and the A wave, the B wave, they can be, again, corrective, which means they can be quite slow. And the third wave down can be an impulse, and that means it's very aggressive, very fast, which this was. That was one of these wave 2 corrections where there was a lot of fear in the market. I remember that, because we talked about also the news that were around at the time, the banks, and people were really panicking. Because of that, funny enough, even though we were tracking exactly the structure, and I had even a support box here, like a trend reversal area, I used it to buy. It was a great entry point, and even a sizable position, just purely because of technicals. From a had you also in my group, they just didn't buy because they were scared. Okay, so and that's That's the thing. And I'm not saying you blindly buy. Obviously, if you trade this, you have to have a stop loss and things like that. But yeah, that was great. And then you saw here this strong move to the upside. And from how the waves are structured, the assumption would now be that we are, after this wave 2, in a third wave, which would be somewhere up there, here, yeah, in a third wave. So this would be the FOMO wave within an even larger fifth wave, which we just talked about on the weekly chart. But again, this fifth wave also consists of 5 waves. Sorry, the third wave consists of 5 waves. So ideally, it's now like this: wave 1, wave 2, wave 3, 4, 5, and that's how it would take us close to 100K if it all goes well. Now that's one interpretation. Just take that out again. Oops. Yeah. From another interpretation would be that all of this move up was a wave 1, which would mean that we could get a deeper retracement, a deeper pullback. And I would rather always, from a mindset point of view, a risk management point of view, I would rather expect a deeper pullback. If it turns early, even better. But if I would rather prepare people for a deeper pullback. And then, yeah, from a structural point of view, I see this currently as this wave 2 correction that's still unfolding. So basically already in an uptrend.
Just to take you back a bit, because this is interesting. Now, I'm not an Elliotician, but I do see the value in it. Now, when I look at that chart from November's lows, I see the 1 wave and the 2 wave where you've got it. And you're the absolute authority here. But then why wouldn't you have the 3 where the I is and a 4 where the W is, and then a 5, and we're now in an ABC correction? What's your thought process behind that?
That's probably technically possible. It would be, however, a less likely structure. It would be a so-called diagonal structure. It's also not impossible, but it would still take us down lower. So it wouldn't. Yes. It would more be an academic discussion, whereas it doesn't really matter for trading or investing. So it would still lead to the same outcome. But we have pretty good impulsive structures. So that's why we track it like that. It has to do with the Fibonacci levels within it. If I had to count it the way you said, so like 1, 2, 3, 4, 5, yeah?
Yep, that's what would come immediately to me at the chart if I was to apply Elliott wave theory to it right now.
It is a valid interpretation, but it would be a so-called, what we call a diagonal structure, which is also the beginning of an uptrend, but it's a less likely structure. So I always try to go with what's more probable. But again, in the end, it would also mean that, okay, from here we probably start at the A, B, C. So it doesn't make a difference really. So
both roads lead to the same same outcome. And
it might lead to different targets up there, but then we'll probably see that along the way.
And so the current phase that we're in right now, from an Elliott wave theory perspective, it's still a stage 2 corrective move, or are we still, have we now started the third sort of impulse in?
No, the idea is that this is still, we could have, but that's not very evident in the chart yet. So the idea is that we come down a little bit lower for a couple of reasons, really. So the main reason is that the move of these lows here looks still very corrective. So it's not, again, if you understand about Elliott wave a little bit, but it's when you have a lot of overlapping price action, it's very slow. That's what we see here. And the context is always very important. So this low here did not end below this low, which isn't great for a bottoming structure. So that's one reason why I still expect lower. Because what you normally get in these corrections, the last wave of a correction, the last leg of a correction typically shakes out the last fearful trader. So that's typically needed to start the next rally. It hasn't happened yet. You basically need, in a wave 2, that people get very scared, and that's not happened yet. So that's, when we talk about probabilities, that's ideally still what we want. I think on some exchanges, that low actually went lower. So I can't rule out. So I think futures as well. So I can't rule out that we have bottomed. But then I always say, okay, we need the evidence, and we get the evidence by tracking again the next 5 wave move up. And if we get that 5 wave move up, we can say, okay, we have the first strong indication we indeed have bottomed. There's no reason to get FOMO up here, because after every 5 wave move, you get a pullback. And if that's a 3 wave corrective pullback, we can then define another support area. Basically what we did here in large, in small, and then that would provide another entry point. And then we can trade the 3rd wave higher. If you go long now aggressively or anything, you risk that it breaks down, because it hasn't shown us that evidence yet that we have started a new uptrend.
Yeah, I think you've got to listen to the markets, and obviously Elliott wave theory is very good at kind of tracking that. You know, you need to see strength where it's present, and if weakness is present, you go with it. You don't try and sort of I mean, we've been really expressing our uncertainty on the short term.
Yeah,
from a short-term point of view.
It depends. You know, that's also why it's just doesn't work to tell people, you know, you have to buy here, you have to sell there, because it depends on what everybody is comfortable with. I mean, it depends on how much confirmation you need as a trader or investor. So if you want, you know, all the confirmation you get, you probably wait for these 5 waves, you wait for the 3 waves down, you wait for the breakout to the upside, but then you don't get the best price anymore. So I like a mix really of, okay, I basically use this structure. I know we are probably in an uptrend. I use basically what I talk like pyramiding. So I use this basically, I use this support area and say, okay, I buy constantly a little bit here, you know, a little bit here with cash flow that's coming in. And then as we go lower, I buy more and more and more. And some of these positions I might stop out below 18K, but this is purely spot, because the way we are structured now on the daily time frame, I couldn't set a tight stop loss if I'm trading this time frame because the wave 2 allows me to go all the way down to 18K. So what I do is basically just trading the daily time frame. I'm scaling into this pullback, use that to add to my core position, which is basically the position I want to have for the next bull run. On the lower time frame, I wouldn't do anything really aggressively until I have that first 5-wave move up. Yeah, that I just showed you. 3-wave pullback, and then the same way I would just scale into a smaller position, but then could set a stop loss basically below that September low quite tight. Okay, and that's sort of the approach that I would use.
Yeah, I've always sort of thought that it's very hard to apply traditional risk management to the crypto space. Certainly, if you're using any kind of leverage and you're trading the altcoins. You're going to be getting stopped a lot if you try and apply traditional risk management, which doesn't mean you should ignore it. But something like Elliott Wave can give you a bit of an insight and a bit of a better assumption on things in regards to the kind of risk to rewards. And with this structure, so I take it right now, you're still on balance of probabilities looking for further downside.
Yeah, basically that white structure there that takes us down is basically what I prefer. Bitcoin going a little higher today, but you know, it could go higher still in this B wave. That's not a problem.
Of course,
there are certain resistance areas it shouldn't really go above, but it's more the structure that's important. So as long as it doesn't show us 5 waves up, 3 waves down, yeah, the evidence we need, I would expect lower still.
Yep. Until proven otherwise, and that's part of our job, is looking at the charts. When they tell you you're wrong, accept it. Don't try and fight it, because you will cause yourself some real damage doing that.
Yeah, and I'm not saying the low couldn't be in, but that's where then the strategy comes in. That's why I said, look, I've used the last year, a couple of years to build that core position. So you want to position yourself to win either way. So I'm happy when the prices go up because I've got that core position. If you try constantly to be all in, all out of the market, you will probably miss that 3rd wave rally. Absolutely. So I don't want to be all in, all out. I want to scale in, scale out, still have my core position all the time. And yeah, so but obviously when going lower, I will buy more because I'm holding that sort of cash buffer as well. Specifically, that's where strategy comes in, and that's where you need to plan for different scenarios. That's what a lot of people don't understand, where there's always more than one scenario, and you need to understand at least the 2 or 3 likely ones. Then you can come up with your plan and strategy, how you want to position yourself.
Yeah, I think being all in on one kind of, to use that analogy, being all in on one kind of a direction, you know, you can never be certain of it. And I also liked what you said about if we look at Bitcoin really from sort of end of August, that's not typically bottoming structure. Anybody that studies price analysis, Elliott wave theory has, it's quite similar to Dow. It's not similar at all to Dow theory, but if you look at how a market moves, you know, in a kind of expansion, you see your Elliott wave theories playing out, which is your impulse, and then you see a retracement. The retracement is usually descending, whereas it's adverse in regards to a downtrend. You know, your sort of pullbacks, if you will, of the broader trend are ascending. And you've kind of got that with Bitcoin. I kind of said I'd like to have seen Bitcoin put in a kind of, I think it was May 2021, before we'd sold off at 24,000. We rallied all the way down, and then we went to 28. That was in a kind of descending structure that I'd like to have seen Bitcoin form, and I was kind of, really hoping for it. But this ascension is a risk until you see strength come in. And I think you're very much looking for the same thing, even though you've come to it for a kind of a different conclusion and method. So where would you be wrong and actually, well, not be wrong, but where would you say, okay, right, the downside is now less likely to play out? Would it be a taking of those resistance levels, or would it be a taking of the 30K high, 30 sort of 1K high?
No, I would want to see, and I mean, at some point you want that to happen. You want to see that structure. We're just tracking it at the moment. So I just can't confirm the lowest in place. That's why I say, okay, the wave 2 could be finished here, but it really needs to be just that structure. I want to see 5 waves up. That's not enough yet to say the top is the low. Yeah, well, the low is in. I need to see those 5 waves up and then the 3-wave pullback, and we have that. And then a small reaction out of that area. And then I think we can say that we are probably on track to going higher. You will still not be able to confirm it until you take out, until that's the top of the first 5 waves are broken. But then, you know, you don't typically buy when you have confirmation. You buy when reward is high, risk is low, which would be here in the pullback zone, when you maybe see a small reaction, because you don't want to buy necessarily when you're actually trading it. You don't want to buy and catch the falling knife. You want to buy when you have a first indication, okay, it might be turning around, and you set your stop loss below it.
Yeah, fantastic. And then at what point would that take you into your broader 3-wave and out of this 2-wave correction on the short term that you've identified?
Yeah, so the next move up, there would be that, so that if the wave 2 finished here, it would be a 3rd wave. So that would be what I call the FOMO wave. It's typically the most aggressive wave because a lot of people will not have bought, and lots of short positions probably, and then they will have to buy higher, and that will bring the prices up. I mean, as soon as it goes above this high, which is the basically $32,000 level, yeah, that is, I think, when the FOMO will kick in, and that would work out very well with the assumption it's a 3rd wave. And that should take us, based on current projections, that can still change a bit, but sort of between 44,000 to 52.
Interesting.
Then I think it will stay there for a while, and that is when I think that really the alt season is starting, possibly, because then a lot of that money, while Bitcoin might be consolidating for maybe even a few months in a wave 4, which is typically a very boring wave, I think that's when some of that money will flow into altcoins.
Yeah, it's interesting. If you look at the kind of volume, if you do volume by price analysis, above 30K, the only sort of real volume that you're going to run into is in that box, round about that box, 42, 40, sort of 3K. We've also got an inverse head and shoulders target that's going to take you up there. You're getting a lot of confluence. And this is why I really wanted to have you on. I always believe that 2 minds is better than 1 from a technical point of view. And, you know, when you get confluence in technical analysis, I think it's often a very, very good side. And I think right now we're both kind of sat looking for the play of more downside, knowing where to pivot on that, but ultimately expecting that a spring for crypto is here, if you will. The first lambs are already roaming around. I mean, what's your thoughts on that generally? I suppose you're looking for technical confirmation, but would you say you've got enough technical confirmation where we're at right now to suspect that we are now in an uptrend and the market low? Not that you can say that definitely is in.
Yeah, I mean, the evidence we have at the moment, I mean, we have 5 waves to the upside since November, and we're holding above bullish support, and the structure currently that's happening looks corrective. So from what we have now, I would say, yeah, the bear market low is in. Been highlighting that. I think from the moment on when we had the first 5 up and 3 down, that's when I said, okay, we can now assume carefully. I mean, you can never really, I never want to call a low or something, you know, because markets are uncertain. So we always have to be open to changing our opinion, which is very important, which many people don't do. Yeah, which is actually very important. Whenever something changes, you want to be very fast in adjusting, which is what you should be doing. But the problem is when you do it, a lot of people say, "Oh, you said it. You said something different like a few weeks ago." But yeah, but you know, you don't want to hang on to a wrong viewpoint, really. When the market is the boss, I always say, right? It tells us what we should do, and so you have to adjust. And the problem is many people don't adjust, and that's why many people still hold on to their coins from the last bull run, because they couldn't sell them from a psychological point of view. They couldn't sell them when they saw the bear market started, right? And a lot of people didn't get bearish on Bitcoin until it broke below 30K, which is crazy. Whereas Elliot wave, if you watch the videos from December 21 from our channel, we talked about it's going to go below 30K, and there wasn't even a bullish scenario left. So that was Elliot wave telling us we are heading into the bear market, which I probably wouldn't have been able to do with any other method. So yeah, but you said, there is not much there also in terms of structural resistance, so it will probably go up quite quickly. Yes,
all giving confluence to what you're looking at from an Elliot wave kind of perspective, which for me is really interesting, and the value of this interview. What is your kind of take on the stock market? Now, I know you've just recently started up a kind of stock market based course. What's your thoughts on, and let's maybe use the S&P, the US's largest sort of equity index to gauge maybe what your thoughts on the stock market is, because I think it's quite, there's obviously a correlation there, there's confluence. Let's maybe start on whatever time frame you want to take a look at that kind of captures the recent bear market into what's now, I believe, the start of a higher market, and see what you're looking at there. And actually, straight off the bat, that three wave that you've got looks very similar to what we've got on an inverse head and shoulders, and the stock market putting in a new all-time high. But we'll maybe cross that bridge when we come to it. But yeah, let's take a look at what you're looking at here.
So obviously S&P long-term uptrend. I think everybody knows it's all about I think we are. I mean, I've been not on YouTube, but I've been analyzing the S&P for probably more than 10 years, because I've been trading on the side. So, wow. But I've never seen. I've been doing Elliot wave for probably around 15 years, but obviously learned a lot along the way. So I've never seen probably a market that is difficult as today. And that's really from someone who's been looking at this market for more than 10 years. It really is the case, because we're at a major decision point. And maybe I can explain that. So there are obviously two scenarios. There's one bearish and one bullish one, but we're now exactly in the spot where that decision will take place. You see the potential of a potential downturn exactly from here. So it could seriously take us either to around about $2,500 points, or even lower, depending on how far this stretches out. So there's a potential that we are still in a wave 4 correction, that we are actually in a wave 4 correction, which would play out like that. So 2022 high, or end of 2021 high, was here. And the bearish scenario was an A wave to the downside, which is the first wave of such a 3-wave correction. The rally into this year's high, I think it was July, the highs was it was a 3-wave move. So that could just be the B wave. A B wave is a 3-wave move. So the next move down could be a C wave, which is a 5-wave move. And that, measured with Fibonacci extensions, could take us down into, $2,500. So that could be a major crash. So that's why I say we are in a critical situation. I'm not saying it will happen. I'm actually still primarily expecting one more high before that happens. So for me, the question is not if it happens, but is it now, or is it after the next high? Because the orange count, which is the orange scenario, which is the bullish one, tells us that, this wave 3 actually finished here. Okay. So different ways of counting this. And if it finishes here, well, it will finish basically here, probably around $5,500. That would be the next all-time high target, roughly. But then this major, you can call it crash, because it will be a crash, will happen after that. Now, but that might not be before end of 2024, maybe. And we are now exactly in that region where that is going to be, that decision is going to be made. So probably next couple of weeks we should know.
Let's dive into that, where we are right now. But it's very interesting that you're looking at all that, and of course you're giving the both the bear and the bull scenario. Like yourself, we lean more towards a sort of bullish side of things. We've got technical targets.
It's not so much about saying which one it is. I think it was. I mean, anybody who's that was the dog. Anybody who's been following maybe our so we have a YouTube channel where we cover the S&P regularly. In the last few months, I've been saying, okay, it's probably best maybe to not do anything, just to wait what happens, because when we rallied here into these highs in July, my view was there's probably one more high which happened, and then we get a quite significant correction into this yellow support zone, and that's what played out. And we wanted the price to get down into this lower range. Now it's where we see the decision. So now, obviously, you have a great reward to risk ratio to the upside. So it might be worth, if anybody's trading this, to go long at some point. Now that depends on each individual's trading plan, but it's now, again, we are in a situation where basically you're very close to what I would call a pivot point a decision point where reward to the upside is really high compared to the risk, because you basically, if this fails, and I would say it's somewhere below that 4,187 level now, because we are operating on quite a high time frame still and so on. It's not, if we go below this it will crash, but it's more like the structure. But if we see now a first move above resistance, and a first pullback which is holding a higher low, that would be the first indication that we're actually on our way to new all-time highs. And that's exactly what I'm looking for now, because the downside structure is basically complete in this bullish wave count. So that's the moment I'm waiting for, where I might normally, if I was trading this now actively, which I'm not, I might start to to go long, for example, carefully, waiting then, however, for more confirmation to take a more aggressive long position. But it is very close to the point where it can also fail. So that gives you a great risk management approach, because you know, okay, if it fails, then at least it doesn't hurt, because I'm very close to that decision point. I know very quickly when I'm wrong. Whereas if you go long up here, it takes me all the way down there to find out if I'm wrong. So that's why you always want to, let's say, trade very close to these decision points, and Elliott wave tells you where they are. So if we, however, see now not the bottoming structure here, and I think one more low is still likely, maybe to 4,180 roughly. If we don't bottom there, then probably this wide structure will play out. And then we should still see a little bit further downside that will tell us, okay, we're probably in the white wave 1 here, which would be the first wave of an impulse to the downside. Then a corrective move up. That would be the next short trade setup then. If we see that in 3 waves up, and then we can short it down to, I don't know, 2,500. So we are in that period, in that time where we now exactly, where probably the decision will be made for how the S&P is going to move in the next couple of years, to be honest. So it's a major decision point, yeah.
Yeah, very interesting. And there are fundamentals that the technicals, of course, are leading. In regards to, everyone's talking about the R word, the recession word, and we know how the markets typically play out in that context. The interesting thing with rates is everyone thinks rates going up is extremely negative for the markets. Well, actually, historically, every single time they've upped rates over the past 40 years, the S&P's actually gone on to put in pretty much a new high, or at least it's gone higher from where they started upping rates to where they ended it. And actually, once they stop upping rates over the past 40 years, the S&P's gone into putting a new high. There's a kind of a fundamental reason why we think the markets are going to go up. And it's really nice to see your technicals and have both sides put together with sort of technical levels that you're looking at and you're interested in. And how would you count the kind of waves for, this pullback that the S&P is going through? What wave would you say that is?
So from a bullish point of view at the moment, as long as we have 3 waves down of the high, I count that as corrective. So
okay,
which would rather be confirm that orange wave count to another high, because we want in a pullback a 3-wave move. If it turns into a 5-wave move, it's bearish.
Yes.
So, and we are very close to that. So I count it as the first move down here as an A wave. That was the low in August. And you can see, you might just, from a trading point of view, how Elliott wave works, you could just use these boxes to scale in, because it showed a reaction. Okay. We had at the time here a resistance area that could be used to short. And then that's a B wave top, similar to what Bitcoin might be doing now, a B wave top. And then obviously the C wave down in 5 waves, where we had a wave 1, a wave 2, wave 3, wave 4, and we could now be in this 5th wave of the C wave. So ultimately a 3-wave move. So we're getting close to the end of that 3-wave move. And you can see how the market reacts to these Fibonacci levels. Yesterday, I made an analysis and highlighted, okay, it came down here. We probably see a bit of there's one more lower high missing and one more lower low. So the price moved up in this wave 4. That is the wave 4. It tells us what Fib levels we need to use for resistance. And you can see it reacted to it today. And it's probably ideally now, I mean, you can never say it will do it, but ideally now one more low. And then that's the low we are waiting for. That might happen today if it goes well. So we'll see.
Wow. Fingers crossed. Fingers crossed. And relating, I mean, all these markets, we're looking at the S&P against the dollar. We're looking at Bitcoin against the dollar. Could we maybe move on to a little bit of dollar analysis? What are you looking at on the dollar right now? Are the dollars, I think, what is it, 11th or 12th straight week of upside on a weekly candle? What have you got going on for the dollar? Let's maybe explore that a little bit.
So long dollar, I mean, this is long-term view. I am, from the analysis point of view, long-term bullish on the dollar, but I think, again, ignore the time frame, ignore, where that, but generally bullish, because it shows us that possibly of this 2008 low, we are now in what we could call a leading diagonal pattern. So 1, 2, 3, wave 3 peaked in, I think, last year. We can now be in a wave 4. A wave 4 is typically very boring, and we see that at the moment. Yes, short term there is a bit of a rally, but it should take us down lower. We're going to go to the daily time frame in a minute, but eventually we're waiting also here for 5 waves. Now that can take a few more years to play out. 5 waves in this diagonal pattern, which would form a larger wave 1. Then we should get another wave 2. So it should, probably for the next years, it should go a little bit in a range, to be honest. So wave 4, wave 5, finish off the wave 1, then a wave 2 down here, and only then we take off, and that will take many, many years. So
wow,
long-term bullish, but it will probably be a bit in a range, up and down, yes, but it will be quite a bit in a range, in my opinion.
And it's interesting that you're, based on what you're looking at, kind of predicting further downside after this rally. You don't necessarily think at this point that it's the start of a newer trend to the upside. That's very interesting. Certainly when you look at where Bitcoin's currently positioned, and when you look at, the upside scenario for the stock market, this scenario that you're forecasting would very much go hand in hand with that, I think.
Yeah. So on the daily time frame, obviously we're tracking here this wave 4 to the downside, which is a correction. You could say, okay, maybe after this correction is finished, but it should still take us down into the low $90 region. That's always what we need to see. Is this ABC correction going to be enough to correct the entire move? Or is this going to be just a larger first wave of a correction? Then we see a B and then the C wave. And again, that is not a question for now, but it's more like, okay, looking at what we have now from this high in last year, came down in what I would call 5 waves, so an impulse. So that's bearish. So that's probably the A wave of a larger correction, because it was due, a pullback was due, happened in 5 waves. What we see now is then the correction of those 5 waves, which is the 3-wave move in a B wave. Yeah. And then a C wave down should follow later to finish off this corrective 3-wave structure. So basically, after 5 waves, you get 3 waves up, which we have. And, this is one of the typical Elliott wave structures, which we call a flat structure, where you have, again, an A wave in a corrective move. And that's all, you measure all of that with Fibonacci levels, and maybe too much detail now, but then 3 waves down in wave B. And this is an impulse to the upside in a wave C. That explains the rally, because it's a C wave. C wave can be impulsive, so very aggressive. It's moving in this trend channel. And it will go further probably until it gets exhausted, but it's basically already where it needs to be. It doesn't need to go any higher. So what I would call that a full wave count. It's basically full. We now need to be watching for reversal. Now, that doesn't mean it has to happen now. They can always extend higher, but it's probably at a point where it can turn around at any time now. Yeah, where down here we would say, okay, it will go higher, it will go higher, it will go higher. Now it's reached that larger resistance area. And if I count the waves in this channel, it's basically full. So when it now breaks the trend line, that would be the first indication that things are changing, and that could mean this correction, this larger move down is starting.
Wow. Yeah. No, I mean, the dollar's worrying me a little bit because it's just been super strong. And I think, I know we're not fundamental traders, but if you look at the dollar and where it's at right now, you can get 5% on your money just having it sat in the bank. That's quite certainly when the dollar's gaining strength like it is, that's quite a kind of appealing offer. Certainly if you look at the risk, given the environment right now that you may be taking on other assets. Also, you've got real capitulation in the bond market. You're seeing lots of people move into money market funds. I absolutely love the analysis that you've just delivered there on the dollar. I would like to see that scenario play out for my own bags that we've only been accumulating since the start of the year. But it's at what point are you wrong on the dollar? That's really the question that I've got for you. Not are you wrong, but at what point is the potentially more likely scenario based on Elliott wave theory invalidated?
It's going to become increasingly unlikely, this move down, if it's always the same story. So we have 5 waves up now. What we expect next is to confirm this further, obviously, when we break down, we expect a decent move down anyway. Even in a more bullish scenario, you would expect a pullback now, yeah, when that trend line breaks. From a bullish point of view, because we have 5 waves up, you would say, okay, maybe I can count that as a wave 1 again, yeah. So the first wave of an uptrend.
Okay.
But context is so important. So the context tells me that's very unlikely because we have 5 waves down here. Okay, we have 5 waves down. It's very likely that's the higher time frame. It's more meaningful that this is just a 3-wave corrective rally and we come down. Yeah, it's the larger time frames are more reliable. So they tell us this is the more likely option that we now get a more decent correction here. But yeah, I mean, always need to be open to, you know, changing your opinion. So 5 waves up can always be a wave 1, first impulse. If we now see a 3-wave pullback and it's holding support, yeah, then that would be a wave 2. And then, you know, this might be even for someone who wants to trade reward to risk to the upside. You know, there are ways you can trade this even. Then you could trade the 3rd wave higher, but that's, given the context, very unlikely. And if we see, you know, that is when I would say, okay, probably wrong. 5 up, 3 down, and then even taking out this high again, that would need a reinterpretation of the chart.
Yeah, no, that's brilliant. You know, I absolutely have to ask, because I'm, you know, to be totally transparent, spot long crypto since really the 5th of January this year. So we want that scenario to play out, but we're also very mindful of the fact that, look, if certain things start taking place, you cut and run. And it's to go back about what you said a little bit earlier in regards to, you know, we often get flack for, people call it flip-flopping on the charts. Actually, you should be doing exactly that as an active trader and even an investor. And that's how you'll prevent yourself, I think, quite a bit of pain. Talking about risk, talking about dollar, talking about everything. Have you got any thoughts on precious metals?
Yeah. I'm tracking gold, silver.
Gold would be a great place to start. You know, before you show me the bigger term time frame, I'm actually bullish on gold and think it could be going to 3,000. Let's see what Elliott wave theory has to say.
Yeah, I have to say I'm normally rather bullish on gold and silver and wrong in the end than bearish, because from experience I can tell you that if gold rallies, it rallies very quickly, and silver as well. So I would rather buy a little early and be wrong and get stopped out and then reposition lower than miss the rally. That's sort of my strategic approach. So also from an analysis, I'm rather bullish than bearish. And yeah, I mean, at the moment, this is a bigger time frame. So actually, the very big time frame is this, which shows that gold is actually quite close to completing a major cycle. So I think after the next all-time high, it can come down quite a bit. But that can take us to 2,500, maybe even a little higher. The thing is, you see the waves very clearly on this sort of long-term chart. Wave 1, wave 2. It's the futures chart, by the way, but 3, 4, and then this would be the wave 5. So that, as we just learned, it creates it would be the completion of a major cycle, but it's a cycle that has lasted decades. So you can imagine that correction. Typically, you would say a correction, I mean, it doesn't need to take the same time, but at least, you know, it will take years, probably a decade or something of a correction, I would say. I mean, yeah, it's just worth preparing for that in some way. But in the short term, I would still look at higher. And that can take us down to $1,000 maybe again. Okay. Maybe it will be very fast. I don't know. But short term still higher.
Yep.
And I would explain why. Because so it basically is also, it would assume that we are in this 5th wave. Now, again, this chart explains why since 2011 gold had performed so poorly, actually, because we had a 3-wave, so wave 3, which is the most aggressive rally that topped here in 2011. So then a correction started that took into 2017, 2018. In a wave 4, we know that a wave 4 is often very boring. So again, you know, it explains the poor performance. And then, it started rising again. And you see again how the 3rd wave was the most aggressive one. Then we came down into the wave 4. Here again, I mean, if anybody watched my gold videos a couple of years ago, or maybe 1.5 years ago, we talked about this support area down there. So Elliott wave told us where gold should turn around. And again, that actually was quite accurate. We put that onto the chart, I think when it peaked here or here, I can't remember. But it gives that's all Fibonacci work. That all comes down to Elliott wave tells you which Fibonacci levels we need to use for each wave. And if you know which wave it is, then you know which FIB levels to use. You know, some people just use FIB levels for trading, but you don't know which ones are going to be relevant. So primary scenario would be wave 4 of 5 finished here last year, and then we're now in this uptrend. Yep. So, however, I would be wrong on this if it breaks below 17, 19. In the recent weeks, I expected lower prices. That's playing out now, and I haven't seen any bottoming structure yet, but I would expect it between now and 17, 19, or this scenario will fail. If it fails, I have to say I would get quite concerned, because then okay, I could probably still reset this wave 4, but to be honest, this wave 4 already maxed out what it should do. So then probably the bearish alternative would be that the entire cycle finished here, and that would be quite bearish.
And you're looking for that deeper correction, and that's likely going to coincide with the downside for the stock market, Bitcoin going on and putting in new lows. Yeah, it's very interesting how
they all move. They all are at major decision points now. It's crazy. So
I think so.
But that's a great time to maybe position oneself in the market, because you're very close to a point where it could go completely downhill. Yeah, but if it works out to the upside from here, you have amazing reward to risk opportunities. Also in gold, I mean, the gold chart, if we go to the daily chart, it's been correcting since May, so very deep correction. And I haven't seen any evidence it's bottomed yet, but when we see the first signal is turning around, I will certainly go long futures.
Yeah, we're kind of looking at a big bull flag for gold. You know, we've got. It's always very nice for me to come across somebody that looks at the market from a technical point of view under a set of different circumstances that comes to a similar conclusion on everything. I think, you know, that's confluence. And I think, you know, I also agree with your sentiment that things are at a very pivotal point right now, you know, and this is your hard or soft landing. You've got the biggest yield curve we've seen basically for the bond market. That's been accurate predicting crashes for as long as it's been around. You know, something big is coming. The question for us as investors and traders right now is when, because timing is really everything in the markets. And do we have this kind of David Hunter style rally into a crash, which I'm more on I'm more inclined to agree with, based on the fact that rates lag and everything, and there's technical structure there, which gives me confluence with the fundamentals. But there is the other scenario to that, which we've technically looked at today, and Ben, you know, the insight's absolutely amazing, that actually could see that hard landing sooner than expected downside. And it's great that you give both views and what to look for in either. What do you think about gold as an investment generally? I've got to ask you, because I before I got into the crypto space, was really a gold and silver bug. And I guess that's why I found it so easy to kind of merge over to Bitcoin, because, you know, gold's supposed to be an alternative store of value, and you know, I understand and have always had quite a good understanding of the monetary system. But I often feel very sorry for gold investors, because they're always waiting on something. You know, I think a large part of gold's thesis in terms of being an investor is expecting the fiat systems to fail. And eventually, potentially they will. But there's a lot of waiting around. And if you divide gold by the money supply, it's not really done anything, whereas something like Bitcoin has.
Gold, I think, belongs in a diversified portfolio. But I would not necessarily buy it for the value increase. Yeah, for the, you know, I would more
the security that it gives you. I'm on board.
For the security. And so if I want to trade it, I would just trade futures. If I want to have it as security, I would buy gold coins. Yeah, and then I wouldn't have the gold coins because I think I can sell them higher. I would just have them as something, you know, in case you need it.
Yeah. In emergency. Yeah. No, absolutely. And have you got any thoughts on silver?
Yeah, it's quite similar, I think.
Because silver and gold thrown it down over the past couple of weeks. And actually, it's very interesting because the bond market's done the same thing, and so is real estate. I don't know, and I've got to ask you this. Do you track real estate at all?
No, I don't track no.
Any of the ETFs? Yeah, they all threw it down basically after Jerome Powell's speech, because the markets are kind of going, oh, well, you know, where are we at with monetary policy? But yeah, on to silver. It'd be really interesting your take here.
So silver, I need to look at the long-term chart again, but actually my chart suggests that it's much more bullish than gold, because in the short term, while they move together, the analysis actually shows that silver already completed that larger 5-wave move here already in 2011 and has come down in a wave 2 correction, basically preparing for a wave 3 to take off. We could already be in that third wave and just in the 1-2 of the third wave. So that is actually much more bullish than gold. So I'm not sure how that will work out.
Do you know, there's actually something else that points to this, and I'm sensing a bit of a bromance here already between me and you. But if you divide gold by silver, I don't know if you can do that on your chart.
Somehow, probably.
Yeah.
Gold silver ratio, or
gold silver ratio, basically. So what is that? Silver divided by gold. I think actually that looks very toppy and very likely that gold is essentially going to roll over against silver and silver value, and you're going to see a big move. If you get those two charts up, I'm sure I can throw it in a little bit later. Actually, if you look at the gold and silver ratio, gold is very toppy and heavy, and actually that could lead to what you're looking at here in regards to being, silver doing well and outperforming.
Yeah, it's interesting. So the next major move up should take us definitely above $30, and then I guess it's going to be the first time, well, for years that we've been there, and then here this $50 level is going to be a target for maybe this third wave there. So yeah, it's going to be interesting. I mean, I would have silver and gold. If I was investing in precious metals, I would have silver and gold.
Yeah,
gold probably more for the security, and silver more for the appreciation part, capital appreciation.
Yeah, and I always think that there's maybe some people listening to this that don't invest, and I honestly believe, and I've changed my life through investing, that investing is one of the keys to moving the financial, probably the biggest, in my opinion, key to moving the financial needle in your life, other than going out and starting a business that changes the world in some way, shape, or form. What's your? Do you think everybody should be an investor? What do you think on that?
Well, I think everybody should at least have a plan for their finances, right?
Yeah.
So I'm a fan of diversifying. I mean, not obviously coming sort of from a YouTube point of view, mainly from crypto, but I think it is so important to have that diversified portfolio. Maybe basically, in case things go wrong, you want to have a portfolio that is fairly balanced. So you want to have a portfolio with assets that are not necessarily correlating altogether. So you don't want to be all in crypto because they all correlate. You want to have maybe even stuff that's not correlating at all. Like, for example, and that's one of the next things I want to look into, maybe even whiskey investments. Wine and whiskey is something.
Barrels of whiskey. Yeah, absolutely. Well, I'm in the right country for that. If you, if you ever feel like doing it, and actually diversifying a portfolio, that is alpha in the sort of portfolio management space. They basically figured out that, and actually volatility, they enjoy it, certainly when things are uncorrelated. If you and this is the kind of thinking with it, a lot of investment funds, if you diversify in assets that are uncorrelated, it really reduces your overall risk. And I think you're spot on about that. I'd really like to maybe finish off. I can see the Ethereum chart there. As Ethereum is the largest altcoin, I'd maybe like to bring this back to crypto and finish off on Ethereum, and if there's anything you're looking at in particular with it.
So Ethereum, we can also look at the daily chart maybe. It's very similar to Bitcoin. Interestingly, on the Ethereum chart, Ethereum is probably going to be more bullish than Bitcoin. Short term, there are a few things that explain why. So also it's a very similar structure, but the thing is, it's more bullish because, at least from what we see at the moment,
the basing.
This move up started already in June 22, whereas Bitcoin put another low in place in November. So it's basically we would say one wave ahead of Bitcoin. So it's already further advanced. So it will get, because it has a nested, so-called nested 1-2 structure here. There are more waves to the upside to come, basically, to keep it simple. So it should travel further than Bitcoin, and should outperform Bitcoin. But from a correction point of view, very similar, should also come down a little lower here, like Bitcoin, similar structure that we discussed on the Bitcoin chart. One more thing that tells me why Ethereum is probably going to outperform Bitcoin is the ETH BTC chart. I'm tracking that as well with Elliot waves. It's not so reliable,
Fantastic.
But it basically tells us which one is going to be stronger. And ETH BTC is basically, so if that chart is bullish, so if that chart is bullish, Ethereum is going to outperform Bitcoin. And if that chart is bullish, it often coincides with a bull market on the USD charts. Often, not always. So we are currently also here, we enter that target range, also talked about this for months now. So currently we see that Bitcoin is outperforming Ethereum. From a wave count point of view, this is basically now in the last wave down. So if I was accumulating Bitcoin and Ethereum, I would probably put more emphasis on ETH, because over the next year or so, we expect this impulse to the upside in the C wave, and that could massively outperform. So ETH could massively outperform Bitcoin. So that all ties back to the USD charts, where Ethereum is actually one wave ahead of Bitcoin, and there are more waves to the upside to come. And also in terms of the targets, if I measure the percentage move potential, Ethereum is going to outperform Bitcoin, most likely, from everything we see right now. So it's interesting because it's now in this target area, and I'm just waiting for this turnaround. And I think if we get a turnaround here, it's now in a fifth wave. It can probably still come down a little lower. If it's turning around here, I think that could come with a major turnaround on the USD charts as well, potentially.
Wow. Yeah. Yeah, do you know, and a lot of people don't do this, but if you're into a certain altcoin, you should, I believe, always check on it relative to BTC, because an altcoin that does well is likely going to also not only outperform the US dollar, but also outperform Bitcoin and its peers, even divide them by Ethereum, all of this sort of stuff. I think that's really helpful. And again, coming back to why we set this up, really the importance of technical analysis. It's not going to give you a crystal ball, but it's going to give you a way better insight to the markets than any kind of fundamental analysis will. You know, I think we both truly believe that. And I think it's very interesting, again, everything that you've shown, even though we've come to similar conclusions through different methods, both technical analysis, but different styles of it. I think that's very encouraging, but also not a guarantee. You know, we both got, I mean, I would say I'm more bullish than bearish right now, but that's something that can change very, very quickly. Very interesting.
It also depends on the time frame you're looking at. You know, you could be bearish on one time frame, and you could be bullish on the weekly time frame, bearish on the hourly. I always say, you know, it's so important because a lot of people watch videos and then they trade based off them, whereas, you know, it is a tool. You know, you also can't, you can't build a house with just a hammer. So you need the skills. So I always say trading is not only the analysis, it's the trading skill is at least, you know, if you take it, maybe 33% analysis, 33% trading skill, and then 33%, and that's the most important thing and the hardest, is emotions. You can have the best analysis in the world. If you don't have the skills to be able to set your stop loss, or where you position yourself well, position sizing, money management, you're going to blow up. And if you have the best analysis in the world, but you're too scared to pull the trigger, the buy trigger, then you're not going to make it. It's and
I think we're both champions of just actually telling people what you're getting into if you want to be a trader. It is not an easy game. Trading is one of the hardest things that I've ever done. And emotionally as well, it's extreme. It can be very, very taxing. You know, you're having a bad day, you've lost money, the other half might want to come in and ask you about it. And it can also impact your family. You know, there's the harsh reality for trading and traders is the vast majority of traders lose money. I think to the tune of 80+%. There's a guarantee in trading, and that is that you will lose money. Good traders just make more than they lose. And that doesn't mean they get more trades right. It just means that they know how to manage themselves, the risk, and the psychology. Van Tharp speaks about it a lot. You know, you need to be psychologically savvy to be a trader, or if you're not that, implement things that will help you to be that. And what were you going to say there? Sorry to interrupt you.
Yeah, no, sorry, I was interrupting you. So no, it was more about, if most people, it's so easy, you know, people go register with an exchange, leverage, and they just, like, I don't know, do something crazy, and they blow up their account. Whereas I always say, you know, the first thing you should do if you want to trade, you need to make sure that you know how not to lose money. And if you don't lose money, then first of all, the profits will come by themselves. Well, you will always lose something, but you have to limit it as much as possible. So then the profits will come by themselves. And if you don't lose money, then you're better than more than 90% of the traders out there. So that's the first thing. Before you think about making money, you need to think about not losing money.
It's twice as important.
Yeah.
Yeah, it really is. No, I totally agree.
If you lose what you trade with, you can't trade anymore. So it's basically you lose your tool, right? So you don't want to do that.
Just on a mathematical term as well, you know, if you make 50%, you know, you have £100 and you make 50%, you know, then you've made 50%. But if you lose 50%, you've got to make 100 just to get back to where you were. So there's also a kind of mathematical. There's a whole thing. There's the forefathers of really what we're trying to do with technical analysis knew in many regards what they were talking about when it came to risk management. And you're talking to somebody here that's actually blown up multiple accounts in my early days because I didn't listen to people like Ben. You know, I went out there, I played with big leverage wherever I could get it, traditionally in the FX market, which I actually think is not an easier market to trade, but a little bit less of a little bit more of an easier time to trade. But the real lesson there was risk management. You know, if you're trading crypto with leverage, it's dynamite, you know, and I've seen people who I really respect actually blow up accounts later on by getting into the crypto leverage game. It's just so unpredictable, and risk management, like Ben's talking about, is absolutely key. Ben, where can everyone find you? Because we want to herd as many people as possible over to where you are, because in my opinion, you're the real McCoy when it comes to this stuff, and this has been thoroughly enjoyable. Where can people find you, Ben?
So we've got 2 YouTube channels, MoreCryptoOnline and MoreTradingOnline. Obviously, crypto is for the cryptos, and more trading is generally for other assets, or the website MoreCryptoOnline.com.
Yeah, that's great. Thank you very much, Ben. It's been honestly a pleasure. We're going to leave a link to all your links in the description. So if you want to go over and check Ben out on Twitter, you want to go and check the MoreCryptoOnline website out, you want to go and check him out on YouTube, all the links will be in the description. Ben, the last thing for me to do is thank you very much for coming on. It's been an absolute pleasure. It's always enjoyable to talk to a fellow technical analyzer such as yourself. And a massive thank you from me and everybody watching.
Yeah, thank you. Thanks for having me. It was really a pleasure, and hopefully we can do that again.
I'm sure we will. Thanks a lot, Ben.